Hello and welcome to Livewire's Views from the Top, our series dedicated to bringing you the best ideas and insights from those at the top of their game. I'm Ali Selby and today we're joined by KKR's Richard Schoenfeld for a deep dive into one of the most discussed topics in markets today. Thanks so much for joining us today, Richard. Really keen to get into the weeds of the credit market with you.
Yeah, thank you for having me.
To set the scene, how have credit markets changed over the last two years? Where are valuations today compared to history?
So it's been a really interesting couple years. If you go back to a couple years ago, as the Fed started its rate hiking cycle, volatility spiked, and there was just a big pullback in activity levels in our market. I think the biggest thing that feels different today, as spreads have started to compress and liquidity has improved in the system, is we're seeing those transaction activity levels pick back up again. Which is just a kind of strike difference from where it was a couple years ago.
We've just seen the Fed cut rates by 50 bips. Where are you seeing risk and opportunity today compared to 2 years ago?
So 2 years ago, we were all having the debate about, are we going to face a hard landing, a soft landing? I think we'll probably spend more time talking about that, but we think there's more going on beneath the surface than many would appreciate. However, I think some of those severe downside scenarios have been taken off the table. It feels like there's more consensus around the market that we've found a path to more of a soft landing scenario. Because of that, we have seen spread levels reflect a more benign macro backdrop. And so spreads today relative to a couple years ago certainly have come in fairly materially.
How has the high yield market been impacted by this environment of rising interest rates?
So high yield is a fixed rate product. The companies who had locked in interest rates back in 2021, the first month or two of 2022, had really extended maturity runways pretty significantly. There weren't many issuers in the high yield market who faced, on the riskier side of the spectrum, who faced significant maturity walls through this past period. And so I think, as I alluded to before, one of the big themes that we saw was anyone who didn't need to tap the capital markets at these higher rates largely chose not to. As we've started to get more, again, consensus in the market, we're seeing that posture change.
Right. And how resilient are those companies right now?
I think a big thing that is underappreciated, we're very used to hearing the high yield bond market referred to as the junk bond market. The market is very much a different market today than even what it was 10 years ago. More of the market is controlled by corporate issuers relative to companies owned by private equity. As a result, more of the market is higher rated. So we have a more BB weighted market, less CCC, the lowest rated portions of the high yield market. And I think two other factors are pretty important. One would be, over the past couple of years, those who have needed to tap the market have been more, there's been much more secured bond issuance, and so you have a direct, first priority claim on collateral in that downside scenario. That was a market that didn't used to exist. And so I think the big point I'm making is that the quality in the high yield market is higher today than it's ever been. And so with some exceptions to the rule, companies have actually fared very well through the past couple of years from a performance perspective.
I feel like a lot of market commentators are talking about cracks that are starting to appear across credit markets. If not high yield, where are you seeing those cracks start to appear?
So I think the other main investable market, or the other main asset class that we're investing in the traded credit business at KKR, is in the syndicated loan market, or the traded bank loan market. That has been the primary market that private equity has used to finance their buyout deals. It's interesting, I alluded to the bond market having more secured bond issuance. Loans are secured, so top of the capital structure. But what's interesting is, given who is using the loan market, leverage is actually much higher in the loan market than even in our unsecured bond portfolio, which is counterintuitive. The other thing that the loan product has is floating rate exposure. And so while high yield borrowers were able to skate through the past couple of years, having locked in very low cost of funds for an extended period of time, loan borrowers were facing higher interest rates on a more day-to-day basis. And so we've seen cash flow coverage of their interest deteriorate. And so we've seen a lot more stress appear in the loan market. I think for a firm like ours, that creates opportunity, but that's more where we're seeing more stress in the market.
What does that stress actually look like?
So I think in the loan market, a big theme for us is downgrades have outpaced upgrades in the market. And the loan market is very ratings driven. Right. The bulk of capital in the loan market is rules based in how they think, meaning there may be strict governors for different investment vehicles about how much different ratings class exposure they may have. And so if a company gets downgraded from single B to triple C, that can create real forced selling in the market. I think that's an arbitrage opportunity that we love to be the liquidity provider in some of those moments where good businesses can be downgraded for an explainable, understandable reason. But we're really trying to find what are the babies thrown out with the bathwater versus where is there true stress.
Let's talk about that. What opportunities are you really seeing today?
So I think the big opportunity is that we're seeing in a market that is more expensive from a spread perspective, what that misses is that there's still a lot going on under the surface in terms of dispersion. What I mean by dispersion is it's a winners and losers type of market. You've got companies that are performing well who have been fully embraced in the market. The other end of the spectrum, though, is that where there's volatility in performance or underperformance, we're seeing true weakness in how those credits are being accepted. That dispersion is, I think, for a strategy like ours, which really looks to be a credit picker strategy or a stock picker like strategy, we can find real opportunity in some of those unloved names or unloved sectors.
Where are you seeing relative value globally? Are you moving away from the US and looking in more Europe or other global regions, or are you focusing in on the US?
So one of the big benefits of being part of a firm like KKR is we have a global presence. We have credit professionals in the US, in Europe, in Asia. And our team is all set up very similarly. Our core approach is we want to be the best at understanding businesses and the business models in different subsectors. And we have the flexibility to look up and down the capital structure across loans, bonds, and across borders. So I think what our core approach is where are we finding the best opportunity? Sometimes that might be, from a very bottoms-up perspective, U.S. bond. Sometimes it might be a European term loan. I think having that global perspective is just really important in a market like we're seeing today.
But where are you specifically seeing opportunity right now?
So I would say we're finding opportunity both on the European side and the U.S. side. I think really the opportunity we're finding more at the bottoms-up company picking level. Then I would emphasize the U.S. market versus the European market. The European market is much smaller than the U.S. market, and so our portfolios do weight towards the U.S. market. But I think we're actually finding a lot of interesting relative value in Europe that many in the U.S. wouldn't see.
Okay. Is there anything that you believe the market is getting completely wrong today? Something that you think our audience needs to be aware of?
So I think that's something that we just hear, and we've talked about in this conversation, but spreads are tight, but we don't think that tells the full story. I think the big thing from my perspective is that in a world with dispersion, with higher quality, and with really a lack of refinancing activity over the past couple years, we have seen quality improve. And second, as transaction activity really starts to pick up, there is still a lot of credit that trades below 100 cents on the dollar. As that activity picks up, there's an opportunity to capture pull to par opportunity that I think the market often misses as they think about just simply spreads. I think you need to take a multi-factor approach to thinking about the returns available in the market from a yield perspective. Where are spreads? Where are dollar prices? I think all of it factors into our thinking. I think the big thing that I think is underappreciated is the probability of some of these pull to par catalysts playing out has increased as the market has started to reopen.
What are those catalysts?
So we've seen the M&A market really start to pick up, which started mostly with strategic buyers. We're now starting to see private equity dip their toes back into the M&A market. I think there have been a few factors that have impacted that. One would be financing availability has really improved for borrowers, whether that's on the private credit side or the reopening of the traded credit markets. And we're also seeing, in order to raise new capital on the private equity side, what we hear is there's still a need to start to monetize what they've invested in over the past number of years. And so I think the incentives to start to transact again have increased. The other big catalyst that started to play out is just in really in the financing markets, which we've touched on. That's happening in regular way refinancings of traded credit positions. It's happening with private credit really starting to step into the traded markets. And it's happened with, still at the early stages, but we've started to see some IPO activity as well.
Let's stick with that. We've obviously seen this flood of interest in both private markets and credit markets over the last few years. You talked before about private markets stepping into tradable credit markets. How does that impact that asset class?
Sometimes people ask that question and imply that is private credit encroaching on our opportunity set? Are we seeing less opportunity because private credit has grown as an asset class? What's been interesting to see is I would describe private credit as just another tool in the toolkit of what options borrowers have today. What historically might have been a transaction that a company would have chosen just to go back to the traded loan market or the bond market, today they're also exploring what would a private credit solution look like. And I think where that's been beneficial for our portfolio is we're seeing situations that historically would have been a more difficult traded credit answer go to the private credit markets. And so we're actually seeing some positive catalyst of deals that are trading below par getting refinanced in the private credit market, often at the higher end of the risk spectrum. So that's been a nice tailwind. I think the two markets are, we're seeing that go the traded markets to the private markets. We're seeing private credit deals get refinanced in the syndicated market. So it's certainly not one directional, but it's a theme that feels much stronger today than it has in the past.
What does it actually mean for investors, though, that is happening?
I think it's, from my perspective, it adds another layer of downside protection to credit today, is that issuers just have more availability of capital than they had in the past. They have options to deal with maturities, and that's the big, I think the biggest takeaway I would have.
We've come to the end of the interview. We always ask our guests the same question. I want to know something that you've learnt recently, whether it's a piece of information, you've met a management team, it's something that you've learnt via many, many years in markets. What is your unique view from the top?
So I just crossed the 10-year mark being at KKR, and one thing that I think I appreciate today in a way that I didn't appreciate 10 years ago is it's really important in the investment business to find the right mousetrap of how you identify mispriced opportunity. But I think the thing that I have really underappreciated, or I value more being part of the traded credit team at KKR, is understanding why opportunities present themselves. And I think something that I underappreciated in my early years was the supply and demand of capital, the technicals in the market, what is creating buying activity, what is creating selling activity, is just as important as identifying where the opportunity is. So I think that's something that I feel kind of is a more central part of my own thought process than I used to believe.
I love that. Thank you so much. It was awesome to feature you on Views from the Top. Thank you for coming to Sydney to do this interview. If you enjoyed that too, don't forget to subscribe to Livewire Markets YouTube channel. We're adding so much great content just like this every single week.